Okay, once again, welcome back to Accounting 401 Taxes, Individual Taxation, Chapter 7, Investments. I was going along great guns there. I looked at my screen and it told me that I had lost my internet connection. So that has happened to me before and probably will happen to me again. So what I had to do is go through, stop everything, and then go back, review the tape, see how far I had got before it cut out, and I didn't lose too much. So we're going to pick up on page hmm, bottom, middle or bottom of page 7-12. Um, the netting process, netting capital gains. It can get kind of involved, but basically, 99.9% of the time, all it is you offset the uh, ca- short-term capital loss against the short-term capital gains, and then you offset any capital loss, any capital gain by the long-term capital gains by the long-term capital loss, and then you net the long-term and the short-term. If you have a gain, you pay the tax. If you have a loss, you can deduct up to $3,000 per year of that uh, capital loss, net capital loss, against ordinary income. Meaning, if you have a Schedule C or Schedule E income or wages, W-2 earnings, you're making $53,000 a year in wages and salaries on your W-2, and you have a $3,000 capital loss. You can uh, use that as a reduction to offset that $53,000 of W-2 earnings and only pay tax on $50,000. Okay, but basically that's the rule you wanted. And again, that would be $1,500 if you're a married filing separate. Okay, so and the reason you need to do that is long-term capital gains are taxed at a different rate than the short-term capital gains. So that's why we have to do the netting. And you can carry that $3,000 forward indefinitely. So if you had a $10,000, after you do your netting process, if you had a $10,000 capital loss, you can take $3,000 against this year's income. That's 3,000 against next year's income. That's 6, and then 3,000. In 3 years from now, that's 9, and then 1,000. The last $1,000 for the 10,000 in the fourth year from the current year when you incurred the loss. Now, again, in intervening years, you can have gains or losses. And example 7.7 there on page 713, they show you the stock portfolio is the basis of capital gains or losses, and the type it is long term, short term, and they walk you through the netting process there. Okay. Now, if you have some of those weird capital gains or losses, the Section 1250 property, the collectibles, the small business corporation stock uh, that are at different rates, you have to net them against those things first. And uh, the netting process separates capital gains and losses into short and 3 different long-term categories because you have the different rates. So it's a little bit more complicated. It's basically the same thing, except you're doing it on different levels for the different tax rates, depending on the asset involved, the capital asset involved. You want to keep capital assets or that are in this tax at the same rates against each other in the netting process. That's basically what it is. So they have the steps there, step 1, 2, and 3. And again, most softwares will walk you through this by asking you questions or just putting the information from a form that you get from the issuer and the source of the income, and it'll tell you what form and what line or block to put it in. Okay, there's a 7-step process there, and they give an example walking you through that. Spend some time there, not a whole lot, but spend some time. The key facts after that example, or was that an exhibit? I'm sorry, I think it was an example. Example 7-8, yes. So right under there, they give you the key facts at 25 and 28% capital gain rates. Read that over also. Reporting capital gains and losses. They have a form 8949, and you can see, you could read that form if you want to blow it up. But they you list the stock there, the date you purchase it, the date you sell it, what you sold, the proceeds of the sale, and your cost or other basis in it, and then your gain or loss. Here we had a $6,000 gain on stock C and an $11,000 loss on stock D. So that nets out to $8,000. So you have a $3,000 loss, and you can offset that against ordinary income. Then you have stock A and B, which is your long term. That was your short term in part one. Part two is your long term. And we have a $35,000 gain on stock A, a $10,000 loss on stock B. That gives you a net $25,000 gain, long term gain. And then they kick over to Schedule D, capital gains and losses. And you can see the short term and the long term numbers there coming over. And then you have your $37,000 proceed on the short term, your $25,000 gain on the long term. So that comes down to go back up here. So say the $3,000 line 7 net short-term capital gain or loss. You have a loss in this case. Combine all lines 1A through 6. If you have any long-term capital gains or losses, go to part 2 below. Otherwise, go to part 3 on the back of the form, and that will tell you where they'll fall out on your 1040. Calculating tax liability on net capital gains. 5-step process. An example there, 7-9. And it's pretty straightforward, the example. Again, if the first time you read the steps might be a little bit obtuse, but the example will clear a lot of that up with the explanations. I really like this textbook for the examples they give. A lot better than the examples you find in the IRS publications, trust me. Limits capital loss deduction, like I said, $3,000 a year against ordinary income carried forward indefinitely. And $1,500 if you are married filing separate returns. You get $1,500, your spouse or partner gets $1,500, so you get $3,000. The only thing is why I don't want. So there are a few weird cases where it's better off. Now, some people do it for other purposes. The late Senator John McCain, his second wife, her family has the largest Budweiser distributorship in Arizona. And since he was a political person, he would make his tax return public, and they didn't want to know the public how much money they were really making, so they would file separate returns for privacy that you could only see Senator McCain's income and not his combined income with his wife. They didn't want that out in public. So that was a non-tax reason for filing a separate return. But usually, not always, but usually, again, 99.9% of the time, you're better off filing marriage, filing joint. There are a few circumstances where it is advantageous to file married, filing separate for tax, to lower taxes, but also other reasons. There are non-tax reasons. Loss on the sale of a personal use asset, not deductible. Gains are taxable, but the losses aren't deductible. Again, yeah, I in your gut, that's not fair, that's not right, but that's the law. Capital gains on sale to related persons. The IRS always takes a long, hard look at this because you may have a less than arm's length transaction when it's a related person. Okay, when taxpayer sells a capital loss to a related person, loss is not deductible, and the gain is, however, although they will take a long, hard look at that to see if the terms of the sale were realistic of true economic conditions. Reminds me of a story. There was a doctor down in the Baltimore, Maryland area, DC area, somewhere in that metro area, ran all away from his wife and said, hey, you can have everything, but he had just bought a new Mercedes Benz, and he says, you can have, don't love you anymore. I got this other person. I love her more. You can have the house. You can have all the savings account, all the investments. I can start over. I'll do pretty good. make a nice income. So you have everything. He just didn't want a messy divorce. He gave her one stipulation, though. He said, sell my car and send me whatever you get for it. So, this is 20, 30 years ago. Top of the lane Mercedes was like maybe $65,000, $75,000. And it was a couple months old, and she put an ad in the paper, sold it for $500. And she sent him the check for $500. He said, what? And she said, hey, you didn't tell me what to sell it for. You didn't say market value. And the guy that bought it, a lot of people didn't answer the ads because they figured it was something wrong. And one guy did go over something, nothing wrong with it. She explained to him, I just want to get back at my soon-to-be ex-husband. And so the guy got himself a $60,000, $70,000 Mercedes for $500. Well, they had a capital loss on that. Can't deduct it. So she really got back at her husband. Cost him his Mercedes value and didn't get able to deduct the loss. Wash sales. Consider a taxpayer attempting to do some tax planning near the end of the year and invested in stock and wants to sell it. Well, they have a 30 days before or after a sale, they considered a no sale. In fact, I have one stock I bought last year. The market's gone down. I like the stock. I could sell it because I think it's down about $10 or $15 a share. I could take the tax benefit and then I'd like the stock, so I'd buy it back, but I'd have to wait this period out because if I bought it back within the 30 days, the IRS would say it's not a sale. I would have the same basis as I originally had. I could not. In other words, they're preventing people from creating a tax loss just for tax purposes. Now, again, the 30 days not that big of a deal, but then I could buy the same stock back for less than I originally paid for it, and eventually it's going to go up, and it pays a good dividend. So I have to see if I want to do that. It might have a couple of weeks ago might have been the perfect time to do that for 2023. It has probably gone back up a little bit. I have to watch it a little bit closer and decide what I want to do with it. Again, the key facts there on page 97 or page 723 or 24. I've got a page marker here. I don't know if it's the top of the page or bottom of the page. So capital gains, key facts. It's a very nice summary of what we just went over. That's the gist of it there. Details, you can always go back and pick up the details. Balancing tax planning strategies for capital assets with other goals. Okay. Non-tax considerations. I don't know why they throw that in here because it's a tax course, but I guess they want you to be aware of it so you can advise clients. First, they are able to defer recognizing gain on assets until they sell them. The longer the deferral period, the lower the present value of the capital gains tax when the taxpayer ultimately sells the asset. Again, you're gambling on the rates being the same and the law not changing, or is not changing significantly. Second, they pay taxes based on the gains at preferential rates. Okay, so again, taxpayers like to hold capital assets for a period longer than a year for those two benefits. Get long-term capital gains, always better because you're going to get the lower rate. Whatever the gain is, you're going to pay a lower rate on it than you would as a short-term capital gain, which is taxed at ordinary rates, which would be your marginal tax rate. These advantages provide taxpayers with greater after-tax return on their investments. But again, investors who quickly sell investments pay taxes at higher rate, ordinary rates, and incur significant greater transaction costs. Nevertheless, the taxpayer should balance the tax benefit available for holding the asset with the risk that the asset values may decline when they want to sell the assets in the future. That's the risk of investing. They run the risk that their investments may decline in value. Thus, a productive strategy for managing investment in capital assets is to sell investments with built-in losses. Strategy is commonly referred to as the loss harvesting, and by selectively selling loss assets, they can reduce their taxpayers' taxes by up to $3,000 against ordinary income. Okay. Note, however, taxpayers should not sell investments to gain tax benefits if they believe the economic benefit of holding the investment outweighs the tax benefits of selling the stock. So there's other considerations that are at play there. Portfolio income summary, and that will tell me we're at the end of chapter 7. Nope. interest investment expense. Okay. Again, like anything, any in legitimate cost you incur in generating income is deductible against that income. So if you borrow money to invest, that is deductible. Beginning in 2018, the only expense associated with investments that remains deductible is the investment interest expense. In the past, you could deduct the cost of your Wall Street Journal, your Barron's, your Forbes magazine, anything you service you, Motley Fool subscription, all those magazines that give you investment advice. You could deduct that stuff. If you had before satellite TV, if you had a hotline into Wall Street to watch the ticker, which was a very expensive thing, that could have been deducted, but not anymore. Only the interest and only to the net investment income. Okay. So if your interest is $800 and your investment income is 500, you can only deduct up to 500. Okay, so there's limited there. Taxpayers may deduct their investment interest expense up to the amount of their investment income, not above it. Even though the interest may be higher, you're limited to the amount of interest income. Um, Congress allows taxpayers to elect to include preferentially taxed income in investment income if they are willing to subject this income to tax at the ordinary, not preferential rate. Okay. So again, that's an odd thing that comes into play a little bit, but not too often. I'm going to give an example there to make it more understandable. Investment income, investment interest expense, key facts. There's a nice summary there. Interest expense on loans used to purchase taxable investments, interest deduction or itemized deduction only to the amount of the interest income. And that would be the interest income on that investment, not all of your interest income. All right. Interest in investment interest expense not deducted currently can be carried forward indefinitely, just like the $3,000 offset of capital loss. Net investment income tax. Okay, again, they're trying to, with this kick, make the rich fair share. They already pay their fair share. This squawk, and I just heard within the last 2 weeks again. Why should a multimillionaire pay a lower rate than a school teacher or a fireman? Well, they're paying a lower rate because it's a preferential rate, and that's what the tax code said they can. What the tax code requires. They are still paying. They're probably paying more tax even at that lower rate than the school teacher or the fireman make a year. They were squawking about that when Mitt Romney ran for president, 12, 16, 20 years ago. That some of his multimillionaire, and he's only paying a 14 or 18% effective tax rate. But they didn't tell you that he was paying $3 or $4 million a year in tax. And again, he wasn't breaking the code. He was abiding by the code. Yes, he was at a lower rate, but they're capital gains. And it was a thing called carried interest, which is, again, a preferential item. And so he took advantage of the tax. And, nowhere does it say you have to pay more tax than the law requires. But he did that on hundreds of millions of dollars, and he ended up paying, $40-50 million of income at a lower rate. He's still paying $3-4 million a year in tax. More than 90% of the population, 99% of the population he was paying in tax. So again, the rate isn't the whole story. It's what that rate is multiplied against the base, the income. All right, so in an effort to kind of equal these things out and make the rich pay their fair share, there's a surcharge on net investment tax. The tax is a 3.8% on the lesser net investment income or the excess of modified adjusted gross income over $250,000 for married filing joint. So again, you're talking about a law that's going to only affect 5% of the population, maybe 10% of the population make over $250,000. And again, that's 125 for married filing separate and 200 for all other taxpayers. Again, you're talking about the upper 10% of the population and wage earners. So it doesn't affect a whole lot of people. And all they do is want to make the rich pay, or what they call the rich people, the higher income people, a little bit more tax. 3.8%. They say, that's not that much. If somebody making $250 million a year, uh, depends where you live. That could be significant. 3.8% on income over that. Again, it's not on that first 250. It's on the amount in excess of that. So again, not a whole lot of tax being generated there. Just a political stunt to make the general population, the 99% people, say, hey, yeah, they got to pay this extra tax. Good for them. Passive income and losses. Okay. You have a couple terms here we have to get familiar with. At-risk amount is the amount you have invested. An investor's risk of loss in the worst case scenario. How much are you at risk? Okay, so in a partnership, an amount generally equal to the tax basis of what you have invested, or if it's a corporation, what you paid, how much you have at stake, how much you are looking to lose. You can lose all your investment. Uh, you invested $10,000 in a partnership and it loses 12,000. You can only deduct 10,000. Passive activity loss, PAL. Tax rules are designed to limit taxpayers' ability to deduct losses from activities in which they don't materially participate against income from other sources. This would probably affect people that have rental units. You have to, if you collect the rent, if you fix up the property a little bit, if you maintain it, there's degrees of what constitutes material participation. If there's nobody doing anything and you're doing a little bit, well, you're materially participating in it. Okay. But again, it was constructed to prevent people from getting into tax shelters. Tax shelters have and deservedly so, have a reputation for being a little bit seedy. And there's people out there all the time, real sharp, conniving people that are pitching these things. I hear it on the radio, invest in these oil and tax leases and you can deduct 10 times your investment. No, you can't. How can you do that? The tax basis limits the taxpayer's ability to deduct operating losses. Again, I had a client that has a subchapter S corporation, so anything would filter back to their personal returns. They were running losses year after year after year, and they, ate up their basis. And I said, you can't deduct anymore. And then, what do you mean? We count on that to offset our other income. And I said, well, then you have to invest more in the corporation to reestablish some positive basis. You can't deduct it if you have a zero or negative basis in the investment. So they got all the stockholders together. I forget if they each threw in $5,000 or $10,000, and that gave them a couple more years of offsetting the losses until they sold the property. And get this, they bought the property back in 1948. I think most of these people are dead now, but they were old when I had them as clients. They were in their 70s, 80s. 1948, they bought some land for $14,000. I forget, it was like 12, 14 acres. They sold some of it for over $600,000. So that price appreciated over 50, 60 years. Yeah, they got killed with taxes. Yeah. But at least it was on the personal rate, not the corporate rate at the time. But they left some money in there because they still had some land, had to pay taxes on that, insurance on it, and a couple other maintenance items. And little by little, those things, there was no income coming from it. They had some expenses, so they had losses. But once those losses absorbed all their basis, the amount they had invested, they could no longer deduct it. So they had to. And again, I think they didn't have enough cash to pay some of the property taxes, so they had everybody get in and kick in some of the couple $100,000 that they split up among themselves. I think everybody got about 120, 140,000. So yeah, you kick up a little bit, keep your basis in the corporation up so you can deduct the losses because of the passive activity loss limitation. Here's a test for material participation, 7 of them. Individual participates in the activity more than 500 hours a year. That's 10 hours a week, or a little under 10 hours a week. Individual activity consists of substantially all the participation in such activity. Yeah, what if the activity does not take more than 500 hours a year? Well, if it takes 200 hours a year and you do most of that, you are materially participating in it. 3, the individual participates more than 100 hours during the year, and the individual participation is not less than any other individual's participation. So again, they had 5 shareholders and they rotated duties. So every year somebody was materially participating. That made it a little bit tough to figure out. Activity qualifies as significant participation activity, more than 100 hours a year, and so that's 2 hours a week, roughly, a little bit under it, and is greater than the 500 hours for the year. Individual materially participates in the activity for any of the 5 preceding 10 taxable years. The individual materially participated in any 3 preceding years in any personal service activity: health, law, engineering, architecture, accounting, actuarial science, performing arts, or consulting. Taking into account all the facts and circumstances, the individual participation on a regular, continuous, and substantial basis during the year. Like I said, I had a client that had 5 rental units, and she'd be over there, she'd be painting. She couldn't do electrical work or plumbing work, so she'd have to have a contractor, a plumber or electrician come in. But she'd cut the grass, she would do the painting, she would do the interviewing of the tenants. She would put the ads in the paper when she had a vacancy and all that kind of good stuff. So she was active in it because that's all it entailed. It's a passive activity, an investment activity, but she was doing a good portion of it. Income and loss categories. This is important. Passive activity, income or loss, portfolio income, and active business income. So Exhibit 7-9, you can see the 3 categories there. And income or loss from activity in which the taxpayer does not materially participate, that's a passive income or loss situation. Portfolio income, including capital gains and losses, dividend interest, annuities, royalties, that is portfolio income or loss. And then active income or loss is activities from which the taxpayer materially participates in or a meaningful way, including salary and self-employment income. Okay, so those categories are important to do some offsetting at times. And again, key facts, passive activities, you can read those over. Rental real estate exception to the passive activity loss rules, probably because there are so many people engaged in having rental property. Applies to active participants in rental property, deduct up to $25,000 of rental real estate loss against ordinary income. And the maximum deduction is phased out by 50 cents for every dollar AGI is over $100,000. So again, not everybody is treated the same. So they're violating the 14th Amendment Equal Protection Clause, but again, they don't care about that. And it is fully phased out over the 150,000 AGI. So again, they're trying to make the people that they claim are on the upper scales of the tax brackets and income levels pay more than people that are in the middle or lower income tax bracket. So you can decide for yourself whether you think that's fair or not. And again, this will usually result in the person lowering their other income, taxable income, and paying less tax. So they want to eliminate that for the middle and upper income brackets. Let's see, a taxpayer who is an active participant in the rental activity may be allowed to deduct up to $25,000. Loss against other types of income. To be considered active participant must own at least 10% of the rental property and to participate in the process of making management decisions such as approving new tenants, deciding on rental terms, and approving repairs and capital expenditures. Doesn't even say you have to do them. You just have to be involved in making the decision to get a contractor to do them. Okay. Net investment income tax on net passive income. Early in the chapter, they alluded to that 3.8% surcharge tax on net investment income on people with higher AGIs. And they give you the example there. And she has to pay net investment income tax base 70,000. The less of 1 or 4, you get 3 point. That would be line 5, 3.8% of that. So she has to pay a little bit more on net investment income being a little bit high given her AGI. Okay, I think that brings us to the end of the chapter. Let me just go back a couple pages here and see if that's true. Oh, come on. Person, yes, finally. Okay. And there's the conclusion, and then we have the key terms and then the questions. End of chapter assignments. Okay, so sorry I had to break it into two. Maybe it's better when it's broken into two. And again, you can stop, view these 10, 15 minutes at a time over the course of the week while you're reading the books to complement your reading of the textbook.